Hello and welcome from Trend Signal for our review of the data and the events affecting the markets this week, the week beginning the 9th of May. Overnight news on Monday morning, oil has perked up a little bit on the back of the Alberta wildfire in Canada, which is threatening the oil sands production. Apparently already up to a fifth of Canada's production has been affected by the wildfire, and eventually, or potentially, up to 800,000 barrels a day could be affected. So a little bit of a negative start, positive start, I should say, for oil. Plus, also, overnight news, Saudi Arabia, in a surprise move, has replaced its veteran oil minister, Ali Al-Naimi, who's been in the position for a good 20 years and has been through a lot of turbulence in his career. But it could suggest that there might be a change in strategy with regard to production cuts, etc., following the failed meeting in Doha when Saudi Arabia decided it would not join in any production cuts if Iran couldn't. But the replacement to Al-Naimi, a chap called Khalid Al-Falih, is also a bit of a veteran, president of Aramco, and is expected to continue with the current policy in the short term. However, I'm sure that speculation is bound to increase ahead of the June OPEC meeting. Last week, let's just get on our calendar quickly. Last week, the market was pretty dominated by the lead up to non-farm payroll. Also a bit of a shortened week, really, with the holidays in the UK on previous Monday and the May Day celebrations last Thursday and Friday to a large extent. But ADP data last Wednesday gave a hint of what was to come from the Bureau of Labour Statistics, and so the data did come in lower than consensus, 160,000 new jobs, with a modest downward revision of March's data by about 6,000 or 7,000. Headline employment rate, or unemployment rate, I should say, remained stable at 5% as expected. Not really good enough, though, the non-farm data. The Americans, I should say, should be producing a good 250 up to 300,000 jobs to provide the necessary self-sustaining lift-off that the Federal Reserve would like to see. So where does that leave us with regard to the economy and the likely or unlikely interest rate rises from the Fed? We talked previously about the rate rises. Over the past 4 months, the market has softened its view on the likely rate rises in the US, and I think this data is almost certain to confirm that a rate hike in June is now off the agenda, or highly unlikely in the main. We can expect one hike this year, maybe, which is quite a change to the beginning of the year, but sometime towards the tail end of the year is probably the most likely time. Wasn't just a weak NFP, but generally US data have been missing consensus over the past month or so. Softer advanced GDP for the Q1, durable goods, consumer confidence, all coming in a little bit softer. There were bright spots. The non-manufacturing, i.e. the service sector in the US came in better than expected last week. But unfortunately, or not fortunately, but the confusion for some traders is that the US dollar didn't sell off on the back of this data, and my response to that is it's already weak anyway, and the markets had priced in less likelihood of a June rate rise. And the other issue is that rates are negative in the Eurozone and Japan, so the interest rate differential between the US and some of its trading partners remain quite marked. Okay, let's have a look at the data coming out this week. As always, post non-farm payroll week, the data is, this is probably the quietest data week of the trading month. We have the Eurogroup meetings today, that's Monday, or happening all day, and Greece has managed to pass its bill through Parliament, re-pensions, etc. That's removed that potential wobble. But the highlight of the week is probably certainly from Wednesday onwards, a lot of sterling market stuff, really. We've already mentioned Cameron talking today, Boris Johnson also talking, some fairly dramatic headlines from the Financial Times. David Cameron raises spectre of conflict in battle over Brexit. I think that's really it sounds a little bit panicking, but that's how the FT's regarded it. And then Boris Johnson is following up with a speech later on, arguing that Cameron did not get a particularly good deal with the EU in the run-up to this Brexit debate, and I think that's another one that will be for the leavers, and obviously Cameron and all the Remainers are rolling out all the big guns that they can possibly roll out. So the debate continues apace. Sterling will ebb and flow on the back of this, and I fancy that unless the polls are very clear-cut, Sterling will be under pressure right up until the referendum. So back to the calendar. The key data this week, manufacturing data out in the UK. As I said, it's largely a sterling market fest this week. We then have Super Thursday, as it's now been dubbed. If you remember, we used to get the interest rate news out of the way, then we'd have the quarterly inflation report, and we'd have the minutes following a couple of weeks later. It all comes out at the same time now, so Thursday at midday you'll have the BOE inflation report, that's the Bank of England inflation report, the Monetary Policy Committee, their intentions on votes. There has been some speculation in the press about possibility that maybe one or two members now may vote for a rate cut. Certainly that was mentioned in the Guardian newspaper. It will be a little bit of a surprise. I certainly don't think there will be a rate cut, but any number of participants of that committee voting for a rate cut could undermine sterling, and I think already sterling is starting to shift a little bit on the foreign exchange markets as we speak Monday morning. And then obviously the monetary policy summary and the number of the voters. So that is a key event for our sterling traders on Thursday lunchtime, affecting obviously all the sterling markets, gilts and FTSE and the like. The inflation report will be interesting because obviously they will be talking about, or the report will be talking about growth or outlook for growth in the second half of the year, which poignantly is obviously after the Brexit vote, whether we stay or leave. It'll be interesting to hear what the bank's views are on that. For the rest of the week, scattered bits of data. Crude oil inventories always provides a bit of a spark for the crude market to see if those gains are sustained following a change in the guard in Saudi Arabia. Retail sales and PPI, probably the most important day of the week for US markets, with retail sales and producer price index coming out on Friday at 1:30 p.m. And then one of our favourites, the prelim reading of the University of Michigan Consumer Sentiment. Consumer sentiment had been waning a little bit, or has been waning a little bit over the last couple of months. We are forecasting a tick up from that at 89.9. Friday at 3 o'clock in the afternoon. That's it. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.